High interest rates, it is the number one reason I hear professional women say they are waiting to invest in real estate. And I get it. A 7% mortgage sounds scary, especially if you remember when rates was in the threes. But here is what I need you to hear from someone who have been doing this for over 25 years. I have bought properties at 6%, 7%, or even 8% interest. And those properties still cash flow today and had helped me financially free. In this video, I'm going to show you exactly how I still buy cash flow rentals step by step, even in the high rate environment. If you are new here, welcome. I'm so glad you are here. I'm Korianne. I started out just like many of you, working a full-time job, raising a family, and wondering how I could ever find the time or money to invest. I bought my first cash flow properties over 25 years ago. While still working in the mortgage industry, I didn't wait for perfect rates. I bought when the numbers worked. By focusing on buy and hold cash flow rentals, one deal at a time, but I built a portfolio that gave me financial independence and the freedom to design my life more intentionally around my beautiful family and my purpose. Today, this channel, Build Wealth with Korianne, exists to help professional women do the same. We are building a supported community of women who uplift each other, share real numbers, and work toward financial freedom together. If that is what you are looking for, make sure to hit the subscribe and tap the bell right now. And as you watch, if you think of a friend or co-worker who keeps saying, I will start investing when rates come down, please share this video with her. She is part of this tribe too. By the end of this video, you will know why the interest rate is only one piece of the puzzle. 3 specific strategies I use to soften the impact of high rates. How to pick markets where deals still cash flow at today's rates. The exact cash flow formula I run on every property, and why waiting for rates to drop can secretly delay your freedom by years. Let's start with the first big mindset shift. When most people look at the rental property, they obsess over one number, the interest rate. But as an investor, the number that really matters is the spread between your total cost and your rental income. That will be your cash flow left. Let me show you what I mean. Imagine the property purchase price as $150,000. With 20% down, that is $30,000. The loan amount is $120,000. Interest rate at 7.25%. Your principal and interest payment roughly about $820 per month. Let's say tax is $130 per month, insurance is $90 per month, total monthly fixed cost is about $1,040. Now, if that property rent for $1,400 per month in a solid Midwest market, you have $1,400 rent, you minus the fixed cost of $1,040, you have $260 before reserve. After setting aside 10% of vacancy and 10% for maintenance, that is $280, you are still left with about $80 per month in positive cash flow. Is that going to retire you tomorrow? No, but here is what it does do. Your tenant is paying down your loan by about $200 per month. The property appreciates even conservatively at 3 to 4% per year. You are building equity plus cash flow plus tax benefits every single month. And you bought that in a 7% rate environment. So instead of asking, are rates high? Ask, does the rent in this market support my total cost and still leave room for cash flow? So strategy number 1 you can lower your payment is seller pay the rate buy down for you. In the hot market, buyers are the ones throwing money at sellers. In today's market, in many markets, that dynamic has shifted. You as a buyer have more power. Here is how you can use it. You ask the seller to pay 1 or 2 points at the closing to buy your rate down. $180,000 property, 1 point is 1% of the loan amount. Let's say your loan is about $144,000. 1 point is $1,440. That concessions from the seller could drop your rate from say 7.25% to 6.5%, which may be the difference between negative cash flow and turn your property into positive cash flow. I recently saw a woman in our community negotiate 2% from the tired landlord who just wanted out. Her payment dropped by $140 per month, and the property instantly went from too tight to a solid deal. The key is this: in many markets right now, sellers are listening. You don't get what you don't ask for, so ask. And strategy number 2, assumable mortgages. Many FHA and VA loans from 2020 to 2022 are assumable. That means you can take over the seller's existing low interest loan, often in the 3 to 4% range, instead of getting a brand new 7% loan. This deal isn't always obvious on Zillow. You often have to ask your agent to specifically search for assumable. Look at the listing mentioned FHA loan assumable, or even ask sellers directly if they have an FHA or VA loan and whether it's assumable. So one woman in our community assumed a 3.5% FHA loan on a property in 2025. The difference in her monthly payment compared to a new 7% loan was over $300 per month. That is $3,600 per year in extra cash flow. Are assumable deals more work? Yes. Are they worth it when you find one? Absolutely. So strategy number 3, go where the math works. In many high-priced coastal cities, the price-to-rent ratio is so skewed that even at lower rates, cash flow is tough. At 7% rate, it's almost impossible. But in the lower cost market with solid rent demand, you can still find properties that cash flow today. Think of markets like Memphis, Kansas City, Toledo, Cleveland, Huntsville. In these areas, you can buy properties in about $100,000 to $160,000 range with rents that makes sense. You do not have to buy where you live. You have to buy where the numbers work. Many professional women in this community live in the high-cost cities, but invest in more affordable markets. And they use property managers to handle the day-to-day operations. You keep your career where you live. Your properties live where they can cash flow. So let's talk about something uncomfortable but very important. Waiting for rates to drop can be a wealth trap. Here is the pattern I have seen over and over in 25 plus years from my peers and people that I know. Rates go up, buyers get scared, demand cools, prices stabilize or softened. That's where we are right now in many markets. When rates eventually go down, what happens? Buyer rush back in, demand spikes, prices jump, sometimes quickly. So you may gain 1 or 2% on the rate, but you lose that advantage on purchase price. Meanwhile, while you have been waiting 2 to 3 years, you missed equity build up from mortgage pay down. You missed appreciation. You missed cash flow. Let's say just a small deal at $150,000 property grow at conservatively 4% per year. After 3 years, it's worth about $169,000. That is $19,000 in appreciation alone. not counting any mortgage pay down or cash flow. That is the cost of waiting for better rates. I'm not saying you should rush out and buy anything. I'm saying the right question is not, are rates high? It's about, is this deal in this market at this price a good buy and hold cash flow property for me right now? Now, let's put this all together with the exact cash flow formula I use on every deal. Please write this down. A monthly rent minus mortgage that include principal and interest, minus taxes, minus insurance cost, minus 10% vacancy, minus maintenance. That will equal your net monthly cash flow. So let's run a quick example. The property rented for $1,500 per month. Your mortgage cost is $900 per month. Taxes $120 per month. Insurance $80 per month. Vacancy 10% $150 per month. Maintenance 10% $150 per month. So the $1,500 minus the $900 minus $120 minus $80 minus $150 minus $150, the leftover is $100 per month net cash flow. Is $100 per month exciting? Not really. But in the context of $200 per month in mortgage pay down, 3 to 4% per year appreciation, tax benefit from depreciation, that one property may be building $5,000 to $7,000 per year in total wealth. Let's multiply that 5 to 10 properties over the next decades. And that's how you replace a salary. And none of that require the 3% interest rates. So here is your homework for this week. And it's simple. Pick one market, either where you live or an affordable real estate market you are curious about. Find one property under $175,000 with at least 3 bedrooms. Run my cash flow formula earlier that I shared. Rent minus mortgage minus taxes minus insurance minus vacancy minus maintenance. If the number is positive, even slightly, that deal has potential. If it's negative, cross it off and find another one. Do this for even one property this week, and you will be miles ahead of many other women who are still saying, I will start when rates go down. So I want to hear from you. Have high interest rates been the main things holding you back from buying your first or next rental? If yes, tell me, what would you need to happen for you to feel comfortable moving forward anyway? And if you have already bought a rental at today's rates, share your story. How did you make the numbers work? Your experience can seriously encourage another woman in this community. This isn't just my channel. It is our space, a place where women uplift each other, share real numbers, and grow into financially independent investors together. Now that you know how to make cash flow rental work, even with high interest rates, your next question is, where should I actually buy? I have got a full video that walks you through exactly how I evaluate and choose cash flow markets, step by step, using free tools you can access today. So click that video right here. Subscribe if you haven't yet. Share this with another professional woman who needs to hear that she does not have to wait for the perfect rates to start building wealth. I will see you in the next video. Ciao!